Hey guys, hope you're doing well out there. It's been a while since we've done one of these industry roundups, and I thought no better space to take a look at than the semiconductor industry, one that's absolutely been red hot over the past year to date, really over the past 2 years. And so we'll take a look at the 4 most prominent names I think you have to absolutely consider when investing in this space. That is Nvidia, ASML, Taiwan Semi, and Broadcom. And briefly, we'll cover these companies, what they do, in case you're unfamiliar with that. We'll also then share some news that's been going around with these companies over the past few weeks. I'll share my fair values on each of these names based on a discounted earnings model. We'll go over the technicals as we always do, and then at the end, I'll share my thoughts on a semiconductor ETF in case you want to get exposure to the space without taking the outsized risk of basically investing in one of these stocks individually. I think if you are interested in this space, I think this ETF makes a whole lot of sense for you. So stick around for that near the end of the video. As always, if you're new to the channel and find this type of content valuable, be sure to hit that like and subscribe button below. It would be much appreciated. Alright, kicking things off with Nvidia. This is one that needs absolutely no introduction in my opinion. I think the year-to-date gain pretty much speaks for itself, and so does the most valuable company in the world title, as this one has crossed that $3.2 trillion mark. But over the past couple of days, you have seen a small sell-off in shares of Nvidia, and so we'll see if maybe that sell-off can continue to last, maybe present some buying opportunities. Now, Truist cut the technology sector down to neutral, at least in the shorter term, following the tech sector massive 40% year-to-date gain, again far outpacing the S&P 500 of around 16%. And so they still have a favorable long-term view of the tech sector, but on the shorter term basis do think that it appears to be overextended. And their thesis is simply that the risk reward in the near term is less attractive at the current time, and they'll certainly look to deploy capital at a better entry point. And to that, I really couldn't agree more. I think if you put risk reward and shorter term in the same sentence, then yeah, absolutely, the tech sector does look overextended, and having that monster 40% run, I think you will have better opportunities and pullbacks in order to deploy your capital in the tech sector. And that really resonates with our second story, is that the gap between big tech and the rest of the S&P 500 is expected to close by year end or Q1 of next year. That's according to Barclays. And the reason this is coming in the Nvidia section is because really Nvidia is the poster child for this rally, up 150% year to date. This is the company that's carrying a lot of those gains that the magnificent 6 or 7 companies in the stock market are really seeing. And so you're seeing an EPS growth gap between the top 6 companies and the rest of the S&P 500 of around 25 percentage points. And so what I think Barclays is at least expecting is that as you head into later in the year and early into next year, the rest of the S&P 500 companies are expected to grow on their EPS growth numbers, whereas you have big tech maybe expected to decelerate in their EPS growth, not certainly go negative, but at least slow down in the EPS growth on a year-over-year basis. And so what you'll have is a broadening out of the market. And right now, maybe I think the market is a bit too concentrated in your mega 6, mega 7 companies, really your big tech. And if you can experience that broadening of the market, I think you can certainly expect the rally in the S&P 500 to continue. But keep in mind, it's all dependent on EPS and EPS growth rates. And so if you don't have the rest of the S&P 500 companies come in and post strong EPS numbers as you move along into the year, yeah, that rally simply won't broaden out. If the top 6 companies continue to post stellar growth rates on their EPS, yeah, well, they'll simply continue to carry the market on their back. Now with Nvidia, we can expect the earnings to absolutely be phenomenal for the next couple of quarters, as we've expected, and as we've gone through the numbers for Nvidia in the past couple of videos. It should really be no surprise that this company has monster financials, at least over the short term, and really even over the next couple of years. They're expected to continue to post strong double-digit growth rates into the near future, and so that forward PE will certainly come down over the next couple of years. Right now sitting, I'd say, close to a 40 times considering the next 12 months. And so certainly for the growth rates you're getting on that bottom line, a 40 times price to earnings, probably one of the more reasonable ones that you're getting over at big tech, believe it or not, despite that monstrous rally that you have gotten year to date in shares of Nvidia. Now, in order to find Nvidia's fair value, we can apply a discounted earnings model. And so if we take their 2024, really their calendar year ending 2025 EPS number of $2.71, and we take an average 5-year CAGR for that bottom line to be roughly 20%, you can see over the next 5 years, earnings expected to come up to $572. That's from an expected $271 this year. And so you're looking somewhere between 15 to 20% growth on that bottom line. That's really what I've taken at close to 20% on that EPS. Applying a 30 times price to earnings multiple over the next 5 years certainly might be a bit expensive, but I think this company will continue to expand into the software services territory. And so that I think will help expand margins over at Nvidia, or at least maintain them to what the levels they are at currently. And I think that deserves a higher multiple. I apply 0.5% in share buybacks each year over the next 5 years. You do also get a small dividend in shares of Nvidia, basically nothing meaningful as of right now, but I think one that you can expect to have certainly good dividend growth in. And so I take our discount rate to be roughly 10% because we do get a small yield with this one, and we want this company to return at least 10% compounded annually. We apply a 10% margin of safety, and my fair value for Nvidia sits closer to $116 a share, certainly not far from the current levels of $126, right around an 8 to 10% downside. Now keep in mind, these growth rates for you might be a bit too aggressive at 20% and a 30 times price to earnings multiple. And so certainly if you have lower growth rates, let's say 18%, and you apply maybe a 28 times earnings multiple, your fair value gets closer to $100. So keep that in mind. If you apply a different earnings growth rate or an earnings multiple, your fair values certainly do change. And my estimates for that 20% bottom line growth, that's over the next 5 years. Again, assuming they'll be able to expand a bit more into the software, and so that will help bolster up earnings. Again, they'll also be able to do some buybacks, helping EPS over the next 5 years. And then that 30 times price to earnings multiple, I think this will be a high quality name for at least the next 5 to 10 years. And that can certainly deserve a higher multiple. And so that $116 price really sitting close to my fair value. Now, from a technical perspective, shares of Nvidia have been on an absolute tear really since November of last year. And so we zoom in a little bit closer, we can see this one has posted a couple red candles and is looking to maybe roll over after hitting its head near the top of this channel. And so maybe if you can expect this one to see a little bit of a pullback, which in my opinion would be absolutely natural for a company that's run so far. If you get that pullback, I think that's where you step into shares of Nvidia. I think your first level that could make sense to enter shares into Nvidia would be closer to this $114, $115 level. I think you have a little bit of support at these levels, certainly not a whole lot. I think the stock had seen a pretty significant rally, and so not a whole lot of levels of support that you can find. I think your probably best solid level of support is right here at $92 a share. So you come down here, I think that's where you pick up shares more aggressively into Nvidia. But I think you certainly don't have to wait until a dip that big to at least begin a position. I think closer to this $110, $115 range, I think you can at least step into and inch into shares of Nvidia. Maybe if you want a 10 share position, you could maybe buy 1 or 2 at this level, and then as it continues to head lower, maybe pick up some more. So I think that would be my overall process with this one. Certainly not trading overly expensive like we saw from an earnings multiple right around 40 times on a forward 12-month basis. And then again, from my fair value estimate, closer to $116 is where the fair value sits for this one, not overly far from the current share price. Now, moving on to ASML, this is a company that's really powering the AI revolution, but behind the curtain. If you think of Nvidia as sort of the Hollywood actor, ASML would be the director or would be the person behind the camera, sort of calling the shots, but that's not really on screen. So this is the company that actually produces and makes the semiconductor equipment that is needed to manufacture the chips that are designed over at Nvidia. And so this is the company that sells their equipment to companies like TSM and Samsung, and they're selling large lithography, metrology machines, inspection systems, really large pieces of semiconductor equipment that is needed to manufacture those chips designed by Nvidia, designed by Intel or Apple, and so on. And so while ASML doesn't come front and center to your mind when you think of the AI revolution, this is still the company that's really powering it all from the sidelines. Without their high-end lithography machines and really semiconductor equipment, none of that would be possible, and the manufacturing of these chips at such a large scale would simply not be feasible. And so along with their machines being so expensive and large scale, that makes them highly desirable. And so the US is urging its allies to curb China's access to more chip making tools, and those chip making tools include these machines from ASML. So we know a couple years ago the US brought in those curbs to export Nvidia's high-end chips into the country of China. Now they're looking to impose additional restrictions into China's access to use chip architecture that is needed for AI. And really that chip architecture is developed using these ASML machines, and they've already seen some restrictions from the Netherlands because this company is headquartered out of Netherlands. So the Netherlands government certainly has restricted ASML in order to export those deep ultraviolet or DUV semiconductor machines into China, and then the US imposed more restrictions onto those machines into Chinese facilities. And so really all this does is I think it hinders China's ability down the road at least to compete in the AI arms race. Certainly if they don't have the leading equipment from companies like ASML and Nvidia, yeah, they could bring up their own companies like Semiconductor Manufacturing International, which is China's largest chip maker. Certainly they could bring those up to speed, but I think that would take a couple of years at the minimum in order to just get to the levels that these companies like ASML, like Nvidia, are sitting at today. And so ASML will still continue to service the contracts that are still effective in China, probably just not be able to sign many new ones. Now, ASML did rise after it plans to ship new EUV or extreme ultraviolet machines into Taiwan Semiconductor and Samsung later this year. And this report, according to Bloomberg. And so TSM, Samsung, and Intel are three of ASML's largest customer, and they will get those extreme ultraviolet lithography or high-end systems by the end of 2024. And these new ASML machines can imprint semiconductor with lines which are 8 nanometers thick that are 1.7 times smaller than the prior generation. They'll be used for making chips which will power AI applications and advanced consumer electronics. And so these machines are really, really desirable over at TSM, over at Samsung and Intel, and really expensive as well, as each system costs about $380 million and weigh around 2 Airbus A320s. And so certainly extremely big, extremely hard to replicate these sort of systems by really any other company. And so we see these ASML systems will stop being provided to Chinese semiconductor manufacturers. And well, yeah, that will certainly be a blow to them. And because demand over at TSM and Samsung seems pretty robust, they're continuing to invest heavily into those machines. And so ASML continues to see a benefit of that as they see 2025 revenue likely to be in the upper half of their guidance range. And so it sort of trickles down as you have Nvidia, the designer of those chips, seeing extremely high demand. They push that demand to a company like TSM, which needs to manufacture those chips. And then TSM pushes that demand down to ASML, which needs to provide the equipment in order to manufacture those chips. And so there's sort of that trickle down effect where everyone in that food chain benefits just a little bit. Now, in terms of earnings growth over at ASML, this year they're expected to decline just around 5% on that bottom line earnings. But then next year you see a ramp back up 55% year over year on the EPS line, with a forward priced earnings sitting closer to 32 times. That's for a 2025 multiple. For this year, you're looking somewhere closer to 50 times. And so really we're around 6 months away from the year ending. And so over the next 12 months, we're actually looking at a forward priced earnings multiple closer to a 40 times. Again, with that growth rate, not wildly overvalued in my opinion for a company like ASML. Now we apply that $20.47 in bottom line's EPS estimates. That's based on 33 analysts estimating for the end of this fiscal year. Similar to Nvidia, applying a 20% forward growth rate on a compounded basis for that bottom line and a 30 times earnings multiple. Again, could be a bit steep depending on how you look at it, but I think the growth rates over this company will continue to be pretty solid over the next 4 to 5 years. And I think you can slap on that 25, maybe as high as a 30 times earnings multiple over at ASML. They are also doing a buyback, and so I added in a 0.5% buyback each year over the next 5 years. You get a small dividend of 0.7%, so that brings our discount rate down from 10% to 9.29%. We apply a 10% margin of safety, and we get to a fair value with ASML at $904, just over $900. Right now, the stock sitting closer to 1,036, and so you're looking at right around a 12 to 13% in downside in order to come down to your fair value. Now again, if your earnings estimates a bit slower growth over at ASML, or you apply a smaller price to earnings multiple, then yeah, your fair value absolutely will and should come down. And so keep that in mind. You make your estimates and adjust your risks accordingly. For me, I think a 20% growth rate on that bottom line and a 30 times price to earnings multiple seems pretty reasonable over the next 5 years. I think this is a company that is in extremely high demand on that equipment side, and really no other company can do what they do, at least at this level. And so they can continue to have those really prominent customers like TSM, Intel, and Samsung keep coming back to them. Now, from a technical perspective, this looks similar to a lot of semiconductor names where you're on a massive 15-year uptrend, dates back to the bottom of 08 and 09, and then more recently, call it over the past 9 months, you've basically gone parabolic and made a far steeper uptrend, continuing in higher highs and higher lows. And so the way I would really play this trade over at ASML is I would wait for a pullback closer to our fair value. That was basically closer to $904. And I think that brings you to a level of support that you saw back in April, and then also a level of resistance you saw back in November of 2021. And so you have a decent level demand at that point, and that's a level where I think you can again begin to open a position in a company like ASML. Similar to Nvidia, you pick this one up on the way down and you inch into your position. You absolutely don't open a position all at once, all at the same time. All four of these companies really are buy and hold names, and so what you want to do is inch into them and build out a position with yourself averaging down over time, and that will really ensure you're not taking any outsized risk at one point and continue to average down as these companies maybe sell off in the short term. And so the first level I'd say is around $900, lower maybe even at $850. And then if this breaks through, I think you again have levels of support here somewhere in the mid 700s. And if it comes all the way down to the 600s, I think that's where you build out your full position into shares of ASML, because you'll once again test this nearly 15-year uptrend. And well, yeah, that'll be absolutely in your favor, while this company will likely still continue to have strong earnings growth expectations over the next couple of years. So a phenomenal company from its financials, really is a very strong company and has a terrific moat around its business. Moving on to TSMC, otherwise known as Taiwan Semiconductor Manufacturer. This one year to date up 67%. We have done a full dedicated video covering TSM's previous earnings, so be sure to check that out on the channel. You also get close to a 1.16% yield with shares of TSM. Now, TSM is expecting to hike its prices for its 3nm chips. That's according to TrendForce, that they're expected to up their prices roughly by 5% on those 3nm chips, and then up those prices by 10 to 20% on the advanced packaging. That's a more sophisticated packaging that sort of TSM provides to their customers. And those 3nm chips are really what are used in the applications such as AI accelerators and high-end smartphones, and of course data centers. And so you have extremely high demand from TSM's main customers like Nvidia, like AMD, like Broadcom even. And while along with having high demand, you have low supply from TSM in the advanced packaging. And so really economics 101, when you have low supply and high demand, you're able to raise your prices. And so the prices for both the 3nm and 5nm expected to be adjusted, and that will prove to be a benefit over at TSM. And a company like Nvidia has already agreed to those price increases in order to secure more advanced packaging. When a company like Nvidia certainly has such high demand, they're willing to pay up a little bit more to their main manufacturer, as really Nvidia at that point then needs to meet their own supply and demand challenges. Now, TSM, Qorvo, and really some other semiconductor names also saw a boost amid the Apple Worldwide Developer Conference, as Apple announced a slew of AI-related products that I think will help these semiconductor names that are really big components in Apple's iPhones. And so TSM, having their biggest customer being Apple, that accounts for roughly 25% of their total revenue. And so if Apple's changing any system on a chip in order to have better privacy, or in order to increase chip content, or have private cloud compute, yeah, all those initiatives are really gonna need more manufacturing of those Apple's AI chips from a company like TSM. And so they expect to see strong demand again for those 3nm nodes in the first half of the year, despite the first half being the low season. You'll also likely see some benefits into Apple's other suppliers like a Skyworks Solutions, Qorvo, Micron, and so on. But I think TSM really is the safest and best bet, considering you have those Apple A Bionic chips and the M1, the M2 chips that go into their Macs, really all being produced by TSM. And so really Apple has nowhere else to turn to other than TSM in order to produce those. Companies like Skyworks and Qorvo really provide certain specific applications within the iPhone that maybe Apple could look to replace at some point or another. They really wouldn't be able to replace a company like TSM. Now, TSM over the next few years on that bottom line earnings also expected to have solid, strong double-digit earnings growth, and then not trading at an overly expensive valuation either. This one trading closer to a 25 times on a forward priced earnings multiple. So certainly that is not wildly expensive for the growth that you're expecting. Now, we expect $6.36 for the remainder of this year over at TSM. That's for the full year annualized. Applying a 15% growth rate on that bottom line and a 20 times earnings multiple, slightly lower considering the earnings growth is also slightly lower compared to Nvidia and ASML. I am not applying any dilution or share buybacks with TSM. I think this one over the past couple years hasn't really done too much in terms of share buybacks, and so assuming their share count will stay relatively flat, we apply that 1.16% yield, brings down our discount rate down to 8.84%. Having that 10% margin of safety brings our fair value for TSM at right around $150 a share. Right now, this one's closer to 174, and so that provides roughly 13 to 14% in downside in order to come down to our fair value. And so again, depending on the growth rate and price to earnings multiple, this one might be somewhere in the ballpark of $140, maybe even lower at $130 for you, depending on the growth rates you take. I think for me, 16%, closer to 15%, and then 20 times an earnings multiple, certainly not overly egregious to put on a company like TSM. I think that similar to ASML, they have an extremely wide moat and a really dominant position in their market. I think Intel is coming for TSM, but well, let's just say they're still a long way away. Now, in terms of TSM from a technical perspective, this one looks very similar to ASML. I have a bunch of lines on here. Let me clear those up. Now, basically making a similar pattern of higher highs and higher lows dating back to your 08 and 09 lows. So really 15-year uptrend is intact over at TSM. In the most shorter term, call it over the past 2 years, this one again making a far steeper uptrend. You could probably remove this uptrending trend line, and so this one you can expect to have some periodic pullbacks, and I think the first level probably closer to that $150 fair value. That would be roughly 13% in downside. I think that also brings back into question the double top you had made back in 2021, and I think that's really a level where you'll see some demand for shares, and I think one of those places where you can begin to open a position in a company like TSM, and then similar to ASML, similar to Nvidia, as it heads lower, I think that's where you pick up shares of TSM. If it comes back down to the 120s, I think you can be a bit more aggressive considering you'll be once again testing this trend line. Last but not least, taking a look at Broadcom. This is a company that resembles more closely to an Nvidia as they design their own chips, but the applications of those chips are a bit, I'd say, wider than Nvidia, as they are still used in data centers, but also used for networking, for telecom equipment, for smartphones even, and so maybe a little bit more on the application heavy side. They're also big into software now that they have acquired VMware. We'll talk more about that just a little bit, but year to date, you're still performing extremely nicely, up 50% with shares of Broadcom. You also still get a small 1.2% yield with this one. Now, shares of Broadcom reported their earnings last week. That was their Q2 results. Revenues up 43% year over year. Keep in mind, they did close that VMware acquisition, and so a lot of that is due to that acquisition. Some of it still organic though, and so $12.5 billion in top line revenues came in with $500 million beat. In terms of non-GAAP EPS, came in with close to $11. That was nearly a 12-cent beat. And so this is a company that, similar to Nvidia, is seeing strong demand for their products and able to raise margins as they do that. In the most recent quarter, came in at $7.5 billion in adjusted EBITDA. That was 59% margins. They're guiding for roughly 61% EBITDA margins for the full year. And so over the next 2 quarters, this company expects to raise those EBITDA margins. On top of that, they also announced a 10-for-1 stock split similar to Nvidia that will go into place July 15th. And so this is a company that's trading right around $1,600 a share. After the split, probably will be closer to $160. Now, the one thing with Broadcom I do want to point out is their balance sheet. So they're sitting on roughly $9 billion in cash and equivalents, roughly 1.8 in inventory. And so total current assets coming right around $25 billion. But they do have a lot of total assets, but keep in mind, a lot of that, more than I'd say 150 billion of that, is tied into intangible assets and goodwill, which is really just another form of intangible assets. And so they don't have a ton of cash and cash equivalents, right around $9 billion. And when we come down to their liabilities, they're sitting on $71.5 billion in long-term debt and another 2.5 in short-term debt. So this is a company with nearly $75 billion of just debt, with right around 10 billion in cash. Now, the reason they picked on so much debt is in order to complete that VMware acquisition, and certainly that acquisition will be beneficial for their revenues and earnings over the next little while. But what that large portion of debt really does for them is this is a company now on a cash flow basis that generated roughly $5.5 billion in operating cash flows for the most recent quarter. We strip off $100 million in capex and we get to roughly free cash flow of $4.3 billion. And all of that $4.3 billion was used towards paying back debt and paying off their dividends. And so this is now a company that's really not able to use that free cash flow for anything other than debt pay downs and paying down their dividends. And so I think that really puts them in a financially tight situation where that excess free cash flow really can't be used for a whole lot else. So I just wanted to point that out, that this is a company from its balance sheet not looking all too great with just that large amount of long-term debt. Other than that though, Broadcom has some of the most consistent and terrific financials you'll see. Now in their Q2, they also expected a boom in their infrastructure software segment as revenues came up to $5.3 billion. That was up 175% year over year. And so this is the part of their business, really that VMware acquisition brought them that software infrastructure that has high margins. And now Broadcom is looking to transition their VMware products into a subscription and licensing model that again will allow those customers to basically become recurring revenue customers. And each of these customers typically sign multi-year contracts. And so that again, allowing a multi-year recurring revenue stream over at Broadcom certainly will bode well for their future. Now this company's growth is a little bit slower than the others we looked at, still expecting 13% growth for this full year that is expected to end in the October time period, and not trading overly expensive at right around 34 times a forward earnings multiple. Still a bit expensive, I guess, for the growth rate, but not egregiously expensive. And then you expect those growth rates to accelerate into next year as your price to earnings multiple comes down. And so with Broadcom, we're expecting roughly $47 in EPS for the full year. Again, this is on a pre-split basis. After the split, this will be roughly $4.07, applying 18% 5-year CAGR for the EPS figure, and then a 22 times price to earnings multiple. This is a company now, again, won't have the ability to really buy back the shares as they'll be focused on paying down the debt and paying down their dividends. And so I took a 1% share dilution per year over the next 5 years. Taking that 1.2% dividend yield, we get a discount rate close to 8.79%. Applying that 10% margin of safety, we get to a fair value close to $13.50. That would be downside right around 20% in order for Broadcom to come down to our fair value. And so that's based on our 18% growth rate on the bottom line and a 22 times earning multiple. Now, from a technical perspective, Broadcom looking extremely similar to the other names that we took a look at. Really over the past 10 years, this one has a pretty strong support line in an uptrending channel. And then more recently, call it over the past 9 months, basically been taking off like a rocket. And so you have a channel of higher highs and higher lows is rolling over the past couple of days. And so the first level, I'd say, in order to step into Broadcom would be closer to that 1350, even down to the low 1300s. I think that's the first level where you pull the trigger into shares of Broadcom. Does have a decent level of support at this point. And then if it continues to head lower, I think you have to be a bit more careful with this one, as you have far more downside before you come down to a really strong level of support somewhere in the 600s. And so with Broadcom, I would be a little bit more cautious in stepping into this one and maybe nibble a bit smaller at these higher elevated levels. Now, lastly, I did mention this semiconductor ETF, ticker symbol SMH, as this is basically how you get exposure into the space. If you don't want to come in here and pick winners and losers, your top 3 holdings include Nvidia, TSM, and Broadcom. That makes up roughly 45% of the ETF, and then you also get ASML in there at roughly 4.5%. And so this ETF, not really super diversified, as you're only holding 26 companies, so pretty concentrated, but I think that is what you want to do with a semiconductor ETF. You don't want to be overly diversified, as you stop seeing really the benefits of the outperformance of an ETF like this, up 50% year to date, significantly outperforming the S&P 500. Really, without the outsized risk of investing in a single company, I think you still get the benefit of the semiconductor boom. You also don't have a large expense ratio, really canceled out by the yield you get over at this one. So that's really my suggestion. If you are looking to get into the space, take a look at the SMH ETF. I think it's the one I would suggest without really having to go in there, pick winners and losers like in Nvidia, like ASM or TSMC. That was my take on all 4 of these companies. Let me know your thoughts on this one in the comment section below. Pretty extensive video where we covered Nvidia, ASML, TSM, and Broadcom. Shared my fair values. Let me know your fair values for these companies in the comment section below. And if you enjoyed an industry roundup like this, let me know what other industries I should take a look at in the near future. As always, thanks so much for listening, and I'll catch you guys in the next video.